And in today's closing bell exchange, we have Bob Pisani here at the New York Stock Exchange. Rick Santelli's at the CME Group. And joining us here at the big board is Tom Belesis of John Thomas Financial. And David Sowerby of Loomis Sales is also with us today. Hey, guys. Hey, Bob, haven't spoken to you. Welcome back.
Thank you.
What's going on? Why the turnaround late today?
Well, I think the important thing is if you look what happened, we saw all the defensive names move. Healthcare rallied. Some of the consumer staple names rallied. Merck was up. Pfizer was up, McDonald's was up, but look a little bit past that, techs and financials, which is the groups you want to have the leadership in, we need now in the second half of the year, they're really doing not much today. I'd say this is a very modest rally for the bull, and given the concerns on earnings, given the concerns about the China slowdown, and the companies have been talking about that, I'd say that this is not a particularly great victory for the bulls here right now.
So let's talk about earnings for a second. What do you think in terms of the earnings expectations at this point? Are they low enough, or do you think these estimates continue to come down for the second half of the year, Tom?
I think the companies are going to surprise to the upside. I mean, let's not forget, on July 3rd, the market became the most overbought since early December. Since then, we've had some unfortunate, disappointing news on the payrolls front, some earnings pre-announcements, on top of the fact that there's very low volume in the market. So anything can shift anything either way, very easily. But I think once earnings come out and surprise to the upside, this market trades higher.
I'm just wondering if the Asia slowdown is showing up in the numbers. We saw it in Burberry yesterday, Bill. Right. I'm just wondering if this slowdown in China is actually translating into estimates cuts.
You know what? I think in certain sectors you're going to see that, but I think in other areas where cash is on hand with companies will be very aggressive to predict that once we have an eventual win in the White House with the new administration, this market will go substantially higher.
David, what do you think's the focus of this market right now? Is it all about earnings, or what else is going on here?
It's a headwind, Bill, and it's going to continue to be a headwind, much like we saw in the summer of 2010, the summer of 2011, the potential to retest the lows, which would be another 4% to the downside. After that, I get more excited about the valuation potential in stocks, but in the near term, it's the disappointment on the fiscal side that we're going to continue to hear lousy rhetoric about the likelihood that the tax bills could go up as much as $600 billion in January of next year. Europe is still a problem until we see Spanish 5-year bond yields decline. And that ISM index below 50 typically is a period when it first goes below 50, that stocks are flat to down in the near term. Those, to me, are all headwinds. Right. And unless we get material news on corporate earnings that North America is holding up well in the face of slowing in China and Europe, it's going to be a headwind. That's simple.
Rick Santelli, more evidence today with this 30-year bond auction that people aren't willing to loan the government some money for very little money, very little return.
Absolutely. 258 yield today, and the metrics of that 30-year bond auction weren't nearly as exciting and wild as yesterday's 10s, but it was still the lowest auction rate on record. And if you look at yesterday's, which was a smidge under 146, the direct bidding being at a record high over 45%, big bond funds, China, these aren't dumb entities. And what the real concern is, as Bob pointed out, even the Federal Reserve in its minutes mentioned, of course, the slowdown in China. Will this not only have ramifications for giving us a clue about the world economy, but it will also maybe give us a clue as to, are they a bottomless reservoir of capital that will keep coming in and helping subsidize our market in terms of purchases of treasuries?
That's why the Fed's going to have to continue to ease. Simply put.
How much more can they ease, though, David?
Well,
there is a limit to that.
There is if you look at how low Fed funds are. But if you look at what they can do with continued open market operations, the tried and true Federal Reserve easing, putting more reserves in the system, I think that's what the Fed is probably going to have to do. But is that what ails the economy, though?
Is that the problem that is keeping us from growing at our normal rate? I mean, you just add more reserves to the system. That's not going to solve our problems, is it?
No, it's not. I believe firmly in the efficacy of money. That too much money creation, if velocity picks up, could prove to be inflationary. But that's farther down the road. What simply ails the economy is this deficit problem, and the fact that corporate America, while reasonably healthy from a cash perspective, perspective, is going to be reluctant to spend on CapEx until we get some kind of news on what's going to happen with this dreaded fiscal cliff.
Bob, let's talk earnings here. What are you expecting, Bob Pisani, in terms of earnings expectations this quarter? Of course, we've got the big J.P. Morgan report tomorrow. That may very well set the tone for the entire sector because people are worried about derivatives portfolio. What's your take on earnings, Bob?
Well, earnings are very muted for the second quarter, but this has always been the lousy quarter. Of the 4 quarters this year, the second quarter was the lowest expectations, and they're slightly negative now. What I'm more worried about, and what I heard a lot this morning, and I've been away for a couple of weeks from the traders this morning, was third and fourth quarter are now very serious problems. When you get the macro environment now this week, you're going to get very cautious commentary on Q3 and possibly even Q4. And remember, that's where the earnings growth is. We're not expecting anything in the second quarter. Third quarter and fourth quarter, Maria, fourth quarter, they're expecting 13% earnings growth in the S&P 500. In bank stocks, where are you going to get 20% earnings growth?
Very quickly, Tom, I mean, that will be a critical report tomorrow, and could it change your mind if, in fact, the financial sector is not going to be a performer here?
It's tough to predict, bank earnings, but I can tell you one thing. I mean, what's going to move this market is confidence. There's been a lack of confidence in the market because of what's out there. But when we get some certainty in the market and the movers and shakers of this economy come back into the market, that's when I believe you're going to see huge upside in the marketplace.
All right. Hope springs eternal for Tom Belesis. Always good to see you. And gentlemen, thank you all. We'll see you all later. It is a volatile day.